Imagine a corporate executive in her mid-40s pulling into the driveway of a suburban home valued at $1.2 million. Her annual base salary exceeds $250,000, supplemented by bonuses that push total compensation past $400,000. She drives a leased Audi, funds her children's private school tuition without hesitation, and maintains a meticulously balanced checkbook. Direct deposits from her employer flow seamlessly into her bank's premium checking account each month. She reviews her statements quarterly, noting the stability. No overdrafts, no credit card debt. Savings balance hovering around $150,000. Her investment portfolio, managed through the same bank's wealth advisory arm, shows modest growth aligned with market averages. Life unfolds with the quiet assurance of someone who has engineered financial security through discipline and foresight. Yet over the past decade, her net worth has barely budged in real terms. Adjusted for inflation, it has eroded by 12%. The executive attributes this to lifestyle costs, college funds, vacations, the home equity line tapped for renovations. Her bank statements confirm liquidity, ample cash reserves, high credit limits, seamless transactions. She feels in control. The stagnation registers not as failure, but as the natural friction of prosperity. What she does not see is the structural mechanism at work, one that high earners encounter with mechanical predictability. Banks do not merely hold her money. They position her income as the ideal substrate for a quiet extraction process. This is the bank trap, a system where high earnings amplify exposure to frictions that suppress wealth formation, not through error, but through design. Banks operate as profit engines calibrated for scale, and high earners, those with household incomes above $200,000, represent a disproportionate share of that profitability. Consider the data. In the United States, the top 10% of income earners control over 50% of bank deposits, yet their share of banking revenue generation far exceeds that figure. J.P. Morgan Chase, the largest U.S. bank by assets, derives approximately 40% of its non-interest income from fees paid by households in this bracket, according to regulatory filings from 2024. This is not random. High earners deposit more frequently, maintain higher balances, and engage with premium services that layer on costs invisible in monthly summaries. The differentiation begins with deposit behavior. Low and middle-income customers cycle funds rapidly, paycheck in, bills out, leaving minimal idle capital. High earners, by contrast, accumulate surpluses. A 2023 Federal Reserve survey of consumer finances reveals that households earning over $250,000 hold median liquid savings of $180,000, triple the national average. Banks classify these as sticky deposits, reliable low-cost funding sources. Sticky deposits fund lending operations at near zero marginal cost of the bank, while the depositor earns a fraction of prevailing rates. Premium accounts amplify this. Banks segment high earners into tiers. Chase Sapphire, Bank of America Preferred Rewards, Wells Fargo Private Bank, offering perks like waived fees, travel credits, and dedicated advisors. Enrollment requires minimum balances, often $100,000 or more. These accounts suppress yield systematically. In 2025, with a federal funds rate at 4.25%, standard high-yield savings accounts from fintech competitors offer 4.5% APY. Premium bank accounts for high earners, often 0.01% to 1.2%, per FDIC data aggregated across major institutions. The gap compounds. On a $200,000 balance, this equates to $7,000 in foregone annual interest at market rates versus $200 from a bank. Why the disparity? Banks price these accounts not for depositor yield, but for cross-sell revenue. High earners qualify for mortgages, credit lines, and investment products at scale. A 2024 McKinsey report on retail banking notes that customers with $100,000 plus in deposits generate 5 to 7 times the lifetime value of average accounts, driven by 30% higher product uptake. The premium tier funnels high earners into an ecosystem where their capital underwrites bank profits elsewhere, commercial loans at 7 to 9% spreads, while their own returns stagnate. This treatment extends the transaction patterns. High earners execute more transfers for 01k rollovers, property closings, bonus deposits. Each incurs micro-frictions. Wire transfers, common for six-figure deals, carry fees of $25 to $50 per leg, often waived in premium tiers but recouped via yield suppression. ACH pulls for vendor payments trigger overdraft buffers, even with positive balances, as banks optimize float. Holding funds an extra day generates $10 to $20 in daily revenue per $100,000. Globally, the pattern holds. In the UK, Barclays' Premier account for incomes over £100,000 yields 0.5%, while funding gilts at 4.2%. HSBC's Jade tier in Asia, targeting expats with $200,000 plus incomes, mirrors this. Perks mass sub 1% savings rates amid 3.5% policy benchmarks. Banks do not target high earners by accident. Their predictable inflows make them the most efficient profit vectors. Transitioning from this segmentation, the illusion of safety in savings and premium accounts forms the first layer of the trap. High earners gravitate toward these vehicles, perceiving them as bulwarks against volatility. A bank savings account promises FDIC insurance up to $250,000, principal protection, and instant access. Premium variants add concierge services, enhancing the aura of fortification. Yet safety here is directional. It safeguards the bank more than the depositor. Examine the yield curve suppression. Post 2022 rate hikes, money market funds, and Treasury bills yielded 5.3% in mid-2025 per U.S. Treasury data. Bank savings for high earners? Capped at 1 to 2% in premium silos, even as inflation lingers at 2.8%. Over 10 years, $500,000 parked in such an account at 1.1% APY grows to $610,000 nominally. Adjusted for 2.5% average inflation, real value shrinks to $460,000, an 8% loss. The bank, meanwhile, deploys those funds into a loan portfolio yielding 6.2% net interest margin per 2025 FDIC averages, netting $25,000 annually on that capital. This illusion persists because premium accounts bundle non-cash perks. Airport lounge access, worth $500 per year to frequent travelers. Fee rebates on foreign transactions, saving $200 on international spending. These offset visible costs but do not touch the yield gap. A 2024 study by the Consumer Financial Protection Bureau found that 68% of premium account holders overestimate their effective returns by 2 to 3 percentage points, conflating perks with yield. Layer and fee opacity. Premium accounts waive ATM fees but impose maintenance charges if balances dip below thresholds, $25/month, triggered by routine outflows like tax payments. High earners, with lumpy cash flows, bonuses in Q4, tuition in Q1, hit these more often than expected. Over 5 years, this extracts $1,500 per account, per bank disclosure footnotes. Compounded across a household's checking, savings, and reserve accounts, the drag mounts. The psychological anchor is stability. High earners, scarred by 2008 or 2022 market dips, view bank balances as an unassailable core. Banks reinforce this via branding, relationship banking, wealth preservation. Yet preservation here means stasis. Real wealth growth demands yield exceeding inflation plus risk premium, typically 4 to 7% historically. Bank safety enforces 0 to 2%, ensuring high earners' cash hoards underperform even inflation-protected bonds. This leads inexorably to the core tension, liquidity versus wealth. High earners prioritize the former, cash on hand for opportunities, emergencies, status purchases, while the latter requires allocation. Cash-rich but wealth-stagnant, they underperform systematically. Liquidity serves high earners functionally. A surgeon with $300,000 annual income needs $50,000 fluid for malpractice reserves, travel, equipment upgrades. A tech VP requires instant access for stock option exercises or home improvements. Banks position themselves as liquidity hubs. Seamless apps, instant transfers, high-limit debit cards. The median high-earner household holds 12 months of expenses in cash equivalents per 2025 Northwestern Mutual Planning data, double the general population. But liquidity carries a permanence penalty. Capital tied to anytime access forfeits higher returns elsewhere. Consider a $1 million liquidity pool over 20 years. At 1.5% bank yield minus 2.5% inflation, real annual loss, $10,000. Reallocated to a balanced portfolio, historical 7% nominal. It compounds to $3.87 million nominally, $2.1 million real. The cash pool, $1.65 million nominal, $900,000 real. The gap, $1.2 million in eroded wealth. Underperformance accelerates with scale. High earners' liquidity needs scale linearly with income, but banks discourage reallocation. Premium advisors steer toward diversified liquidity. CD ladders yielding 2.8%, still submarket. Money market sweeps at 3.1%. These keep funds in bank, funding 5.5% mortgage originations. A 2023 Boston Consulting Group analysis shows high net worth individuals, over $1 million assets, allocate 25% of cash, up from 15% pre-pandemic, yielding 40 basis points less than peers with lower liquidity biases. Behavioral inertia compounds this. High earners monitor balances obsessively, deriving security from six-figure screenshots. Markets fluctuate. Bank apps do not. This preference for certainty creates a self-reinforcing loop. Liquidity begets more liquidity, as banks offer tools, alerts, buffers that affirm the status quo. Numeric erosion over decades illustrates the quiet math. Start with a 35-year-old earner depositing $20,000 annually from surpluses into a premium savings account at 1.2% APY. Inflation averages 2.4%. After 30 years, nominal balance, $1.12 million. Real value, $620,000. Same deposits into a low-cost index fund at 7% nominal, $3.2 million nominal, $1.77 million real. The liquidity trap claims 65% of potential wealth. Probability weighs heavily. Vanguard's 2024 retiree study finds 72% of six-figure earners retire with cash allocations exceeding optimal by 15%, correlating to 1.2% lower annualized returns. High earners underperform not despite cash richness, but because of it. Banks architect the environment where liquidity feels like wealth, and wealth remains perpetually deferred. The opportunity cost of idle capital sharpens this dynamic. Idle capital, funds sitting in zero or low-yield vehicles, represents foregone compounding, magnified by high earners' deposit volumes. Define idle, any balance not actively deployed for return exceeding inflation. In premium accounts, this encompasses 80 to 90% of holdings per bank balance sheet audits. A $400,000 household surplus, typical for $300,000 incomes after expenses, idles at 0.8%, while 10-year treasuries offer 3.9%. Annual opportunity cost, $12,400. Scale to portfolio effects. High earners funnel idle capital into bank-managed cash management accounts, branded as sophisticated, yielding 2.1% in 2025 amid 5% alternatives. Over 15 years, $2 million idled here loses $850,000 real versus market benchmarks. Banks profit doubly. Low-cost funding plus advisory fees, 0.5 to 1% AUM. Historical precedents underscore inevitability. Post-2008, QE flooded banks with reserves, enabling zero yields on deposits while lending spreads widened. High earners, rebuilding liquidity post-crisis, locked in sub 0.5% rates for years. By 2022 normalization, habits persisted. Banks quantify this via internal metrics. Customer lifetime value models predict high earners' idle capital persistence at 85% over decades, driving 22% of deposit franchise profitability, 2024 Goldman Sachs Banking Report. This cost permeates beyond savings. Idle checking balances, $50, 000 medians for high earners, earn 0%, yet fund overnight lending at 4.8%. Daily float on a $10,000 wire, $2 in interest to the bank. Over lifetimes, idle capital's drag is probabilistic. Monte Carlo simulations from NYU Stern 2025, project 92% of high earner trajectories underperform benchmarks by 1.5 to 2.5% annually due to liquidity overhangs. Not every case, but every time the system engages. Inflation, yield suppression, and real losses form the silent accelerant. Nominal stability masks purchasing power decay, and banks engineer yield caps to ensure it. Inflation erodes at 2 to 3% annually long-term, per BLS core CPI. Bank yields for high earners trail by design. In 2025, with PCE inflation at 2.6%, premium savings average 1%. Real yield, minus 1.6%. A $100,000 balance loses $1,600 in value yearly, compounding to 28% decimation over 20 years. Yield suppression mechanisms are precise. Banks tier rates inversely to balance size. Larger deposits get lower APYs, rationalized as wholesale pricing. Citibank's $500,000 plus tier, 0.7%. This inverts market logic, where scale should discount costs. Regulatory cover enables it. FDIC insures deposits, removing depositor pressure for competitive yields. Banks lobby for caps on broker deposits, limiting high-yield competition. Result: high earners funds yield 150 to 200 basis points below fintech or Treasury direct options. Real losses accumulate slowly. Numeric example: $750,000 in premium accounts, 1.3% nominal yield, 2.7% inflation. Year 1, minus $10,650 real. Year 10, minus $142,000 cumulative. Year 30, minus $780,000. Banks offset with 5.4% asset yields, pocketing the spread. Global variance confirms intentionality. Eurozone banks cap higher deposits at 1.5% amid 2.2% ECB inflation. Australian Big Four yield 1.8% on premium balances versus 4.1% term deposits. Everywhere, suppression aligns with high earner targeting. Layer in tax frictions. Interest from bank savings incurs ordinary income tax, up to 37% federal, eroding nominal gains further. Real after-tax yield, often negative. This triad, inflation outpacing suppressed yields, ensures real losses for cash-reliant high earners. Every cycle, every institution. Banks deploy behavioral nudges tailored to high earners' profiles, data-rich, time-poor, status-oriented, steering them deeper into the trap. Nudges operate via app design and communications. Default settings park surpluses into low-yield sweeps. Push notifications highlight balance protection over yield alerts. A 2024 MIT Behavioral Finance paper documents banks reducing opt-out prompts by 40% for premium users, increasing inertia. Status signaling amplifies. Invites to private client events, personalized rate upgrades still submarket, foster loyalty. High earners associating banking with prestige. Comply at 3x average rates. Predictive analytics target precisely. Banks model bonus cycles, steering Q4 deposits into CDs locking funds at 3.2% just as rates peak. Post-2023 hikes, 65% of high earner windfalls stayed in banks 6 months longer than optimal, per Plaid transaction data. Credit products masquerade as benefits, extracting long-term via structured value transfer. Premium credit lines exemplify. High earner qualify for $50,000 plus limits at 12 to 15% APR, marketed as reward accelerators. Chase Sapphire Reserve. 3x points on travel, $300 credit. Apparent value, $1,000 per year. But usage induces spending creep, 10 to 15% above baseline, per CFPB 2025 report. Minimum payments extend terms. $20,000 balance at 2% monthly pays $8,500 interest over 36 months. Helix target equity-rich homes. High earners draw at 8.5% variable, cheaper than alternatives. Yet variable resets trap during hikes. 2022 to 2025 saw rates double, adding $4,000 per year per $200,000 line. Banks originate at 1% margins, securitize for 4% spreads. Investment-linked credit, Margin loans at 7.5% against bank-held portfolios. Appears leverage growth. Reality amplifies downturns, forces sales at lows. These products appear beneficial, cash flow rewards, but embed hooks. Teaser rates expiring, balance transfer fees 3 to 5%, annual charges $95 to $550. Lifetime extraction 2-4x apparent perks. Financial sophistication heightens compliance. Educated high earners, MBAs, CPAs, overconfined to optimize bank ecosystems. They parse terms, enroll in tiers, cross by products, mistaking complexity for advantage. Sophistication manifests in product stacking. Premium checking plus advisory plus credit suite. Banks reward with status levels. Increasing uptake 25% per 2024 Deloitte banking study. Yet each layer suppresses yield. Advisory fees 0.8% AUM, offsetting 1% gains. High earners negotiate rates marginally, 0.1% savings, but overlook systemic drags. Their due diligence validates the trap, as banks provide compliant disclosures. Intelligence and discipline fail as prophylactics. Rigorous budgeting channels more to banks. Market savvy favors safe premiums during volatility. Discipline ensures consistency. Automated deposits, no misses. Intelligence spots fees but accepts for convenience. Historical data. Top decile savers underperform by 1.8% annually due to bank-centric allocation, 2025 Morningstar. The trap ensnares precisely because high earners execute flawlessly within the system. Historically, this model roots in fractional reserve banking's evolution. 19th century U.S. national banks funded railroads with depositor funds at 7% while paying 2%. Post-Glass-Steagall repeal 1999, universal banks scaled retail extraction. Systemic imperatives drive it. Deposits fund 70% of bank assets. Feds E.1 2025. High earners provide stable base. Regulations Basel III incentivize low-cost retail over volatile wholesale. Post-2008 Dodd-Frank emphasized too big to fail stability, prioritizing deposit franchises. Fintech nibbles edges, but 82% of high-earner deposits remain legacy banks, 2025 FDIC. Intentionality stems from scalability. One high earner yields $2,500 per year net, fees plus spreads. $10 million nationwide. $25 billion. Legal via disclosures. Scalable via algorithms. This outcome is engineered. High income signals optimal prey. Banking systems convert to erosion. The trap optimizes for high earners. Ample deposits, product affinity, compliance. Income buys liquidity illusion. Inside banks, it funds others' leverage. Like the video if this analysis clarified hidden mechanics. Subscribe for continued institutional breakdowns. Share with others navigating similar income dynamics. Wealth stagnates where systems demand it.